Here we go. Good afternoon. Welcome to the Merck Employees Federal Credit Union webinar on home buying. If that's the webinar you think you're attending, you're in the right place. We're excited to have everybody here today. Certainly buying a home can be very daunting today. There's so much to know with the real estate market in general. But obviously one of the biggest points is getting funding for your home buying process. So getting a mortgage. Getting a mortgage can be a long, complicated process, and we really pride ourselves here at the credit union in making it easy for people to get a mortgage. So part of what we're going to do today is just, explain to everyone how the mortgage process works. What are some tips and tools, the best things you can do to ensure you have a good process? And we'll talk a little bit about the market, what's going on with rates, and how to best take advantage of the products that we have here at the credit union. As a not-for-profit cooperative, our whole goal is to ensure financial wellness for our members. So we're always going to work to put you into products that make sense and that are good for you. So with that, we are going to kick off and get into it. First, I want to talk about if you have questions. We want this to be interactive. So if you have questions, you can see here on the screen on the bottom right, you can type a question in. We'll try to get to it today. If we don't, we'll follow up with you. So certainly put the question in and we'll do our best to get to it today. But if not, you'll hear back from us and we'll make sure that your question gets answered. So we're going to start. I'm going to introduce our main mortgage broker. His name is Alex Sadusky. A number of you may have spoken to him already. He does lead the process when you're going to go through a first mortgage with us. And Alex, welcome and take it away.
Good afternoon, everyone. My name is Alex. I sit here at the credit union at the physical location, which is the public one, 397 Upton Place here in Rahway, New Jersey. I look forward to speaking with you and answering any questions that you may have. And just to give you a little bit of overview of what we do here at the credit union, we happen to process, take applications, do the underwriting and closing all in-house. So at the credit union, you're not passed around left dealing with automated systems. You're always going to be working with somebody dedicated here as far as a specialist, as far as myself. And then we also have our processing team who knows who you are as a member and also your file from start to finish. And if there's any kind of questions that you have, you're available to reach out to us in real time and get updates and help guide you through the process of getting the loan. Additionally, here at the credit union, we offer very, very competitive rates. The credit union is in a very strong financial position, which allows us to offer very competitive rates. Typically, I would say we are either 0.125 or 0.25% better than most banks or lenders out there. And the reason for that, we are, as Paul mentioned, a nonprofit, and we want to deliver that savings back to the membership. And also, lastly, we are a portfolio lender. And what a portfolio lender is somebody that holds their loans. We don't sell our loans. We keep our loans in-house. This allows flexibility during the underwriting process. It's not a black and white process. If there's some unique income situations, whether it be self-employed, you have bonus income, maybe you recently switched jobs, or even maybe you're a newer college graduate and you just started your career, we have the flexibility to take a look at things under a microscope and make a more informed decision, or like I like to say, a common sense decision to see that it makes sense. Additionally, we are able to customize loan terms. We have a variety of different products here, whether it be a fixed rate, an adjustable rate, and we always take the best approach to put you in the best financial position to meet your needs.
Okay. Next slide.
All right, so a mortgage is one of the most financially regulated products in the United States because it impacts your home, your financial ability, and also the broader economy. There's multiple federal laws such as the Truth in Lending Act and Real Estate Settlement Procedures Act, and it requires lenders like us to fully disclose closing costs, interest rates and terms so they can make a more financial sound decision. Also, lenders are held by the CFPB, which is the Consumer Financial Protection Bureau, to follow strict ability to repay standards. And what that means is we have to examine all of your income documentation, your credit documentation to make sure you're financially capable of making the payment. So that way we don't put you in a predatory lending position where it would impact you adversely during your mortgage process. And as far as what you can expect for the application process, typically what we look for is your income. So we ask for 30 days most recent pay stubs, 60 days of your most recent bank statements, a copy of your purchase agreement, and a copy of the last 2 years of your W-2s. Once we get that, we put everything into process and we take a look at your whole financial picture. We'll run your credit, look at what they call your debt to income ratio, and how much you're looking to borrow versus what you're looking to purchase for. And then we'll formulate what your interest rate would look like. And then at that point, we would also discuss different products that we have, whether it be fixed or adjustable rates. So during the home buying process, there is something called a pre-approval letter. Most realtors require you to obtain this document from a lender to make sure that you're financially capable of obtaining a mortgage loan before they go out and show you these properties and also put an offer on these properties. We here at the credit union offer these pre-approval letters free of charge. It's a pretty simple process. We do not ask you to go through the whole rigmarole of submitting applications. It's mostly on a verbal one-on-one basis. In some cases, we will run your credit to determine what your financial picture would look like. But once we have all the information, we're able to produce this document for you and supply it to your realtor so you can show them that you're capable of obtaining a loan. Typically, the process takes about 15 minutes or so. And also, the letter is usually valid for about 30 days. If for any reason you need to adjust the letter, you could always reach out to us at any time in order to make the adjustments on the fly based upon a higher amount, a lower amount, whatever needs to be done for your particular situation. And then lastly, after you submit an offer, once you have a deal, we would ask that you come back to us and put in a full-blown application. Once you have the full-blown application, that's when the wheels start to move and we start the whole process of disclosing the loan to you, showing you what your closing costs would look like specifically for the property. And then also we would begin the appraisal process. The appraisal process is to determine the value of the home. And what that does is to make sure that you are buying it for what it's worth. This protects both you and the financial institution. So that way you're not getting into a purchase that is maybe not worth what you offered. In cases like these, if the property underappraises, you have the ability to go back to the seller and ask them for a reduction in the purchase price. If they do not, then you have the opportunity to either make up the difference or walk away from the deal completely. But this is more towards your protection. So that way you know exactly what you're getting into and you're not being taken advantage of.
You know, Alex, let's take a pause here. We have a couple great questions. So let's get to those. This is a very common one. People want to know, how much can I qualify for? So this attendee asks, they're going to put down 20%. How can they get an idea of how much they'll qualify for? Is it 2 times salary, 3 times salary, 1 time salary? What's a good gauge to have an understanding of what you would qualify for?
So typically what we do is we look at your income on a monthly basis. And what we do is we multiply that number by 40%. So just to give roundabout numbers, if your monthly income is $10,000 a month, 40% of $10,000 is $4,000 a month. So what that $4,000 a month would encompass would be any liabilities that would show up on your credit report, whether it be auto loans, personal loans, student loans, minimum credit card payments. And once those numbers are deducted, then we factor in what your actual mortgage payment would be, which would include principal and interest, which is to pay the loan back, property taxes, and also your insurance. And that's how we would formulate what your loan amount would look like.
Right. So really important, guys. It's not just your income; it's your monthly obligations. What your debt repayment is, how that will impact how much you can afford for a mortgage. A follow-up to that was another great question. If you have a co-signer who makes more money, will you get approved for more?
That is correct. more income, more purchasing power. But of course, we would also have to take into consideration their monthly obligations as well, whether they have a mortgage or they have a car payment, or any other obligations that they may happen to have. But yes, we can have a co-signer for you in those circumstances.
Right. Another good question. Somebody asked, with 20% down, top credit, would the credit union allow them to opt out of escrow and manage the property taxes by the buyer? I can answer that. Absolutely. We don't require you to escrow with the credit union.
Correct. And it also, we do not have any add-on to the rate to do so. Some lenders may charge you a little bit of a higher rate or a fee. Here at the credit union, we do not do that.
Yeah, so we have no problem whatsoever if you want to manage, paying your taxes, paying your insurance on your own. That's not a problem. Another good question: do closing costs differ based on the lender?
Yes, closing costs do differ based on lender. Typically, when you look at a loan estimate, there's about 6 or 7 boxes that itemize what all the fees are. The first 2 boxes are what the lender charges. So what that encompasses is an application fee, any origination fees, or what they call points, and also any lender charges for appraisals, credit reports, and flood certification. So yes, it does vary from lender to lender.
Yep. Down payment. People wondering, do you need 20%? Do you need 10%? What is the lowest down payment percentage that we do here at the credit union?
At the very least, as a first-time home buyer, you can put down as little as 3% down. But typically, I suggest 5% down or more. And the reason for that being is it's more cost-effective when it comes to something called PMI, which stands for private mortgage insurance. Anytime you have less than 20% to put down, you typically are required to pay private mortgage insurance. And the private mortgage insurance is calculated based upon what your down payment is. So obviously the 3% down payment is the highest risk, which would effectively have a higher premium on a monthly basis. 5% is usually that sweet spot where it starts to become more affordable, where it's not an exorbitant number where you feel that it's too much.
Right. So PMI would add to your payment initially. But one thing important to note about PMI, if over time you develop more equity in the property, you can ask to have PMI removed. Right.
Correct.
Get to that point.
Yep.
So PMI is not forever. So if you decide to pay down more, or just the valuations were much higher, there's always an opportunity to remove PMI. Now, this is a great question, and this is this is where mortgages are so unique. So the question is, what factors determine the rate that somebody will get?
So there are a variety of different factors. So the most important one is your credit score. All lenders look at where your credit score is. They look at how much your down payment is, and they also look at the type of property you're purchasing. The type of property, in some cases, dictates what they call add-ons or adjustments to your rate. Single family being the best rate, and then when it comes to townhouses / condos, they group them together. There's a little bit of a higher rate for those properties because they're considered a little bit more risk, because there is an homeowners association associated with those type of properties. And then lastly, if you're buying a 2-family home, there or 2 to 4 family home, there is a higher rate adjusted for that as well, due to certain risk factors. When you're purchasing a 2 to 4 family home, we can use rental income to qualify you. However, there are unknowns where you may have potential loss of rental income, which could effectively affect your ability to repay the loan. And this, for this reason, is the reason why they have a higher interest rate in the event of potential riskier default.
Right. And another thing that may impact, so if it's a second home, right? This is such a good question, because I think people go out and they look on websites and they see a certain rate, but when you see a rate out there, that does not mean that's the rate you're going to get, right? All
Correct.
these factors come into play. So that's why people put out very low rates, but when you get through all the underwriting, these things do change. So second homes, nobody asked. I think somebody just asked it. The credit also does do mortgages for your second homes. So Alex, what will be a little different if somebody's applying for a second home mortgage?
So for us, as opposed to most lenders, we do not really differentiate between first and second home. We lump it the same. Other lenders may have a higher interest rate, in some cases upwards of 0.5% higher than what a primary mortgage rate would be. So that's what our big advantage here at the credit union. We look at it as long as you're financially strong, the property is a sound property, we don't have any problem offering the same rate as if it was your primary home.
Yeah, that's one of our great advantages. We keep it nice and simple. We don't, differentiate a lot between the first and the second. So that's fantastic. Here's another great question, especially here at Merck, because we run into this scenario a lot, and I'll handle this one. It is, are there differences in interest rates, other terms, if a person is a U.S. resident or is here on a visa status?
Yes, so we do not have any differentiation between the two. We treat you the same. As long as you're legally authorized to be in the United States and legally authorized to work, we do accommodate regardless of citizenship status.
And so we did a lot of work here at the credit union on this because we run into this situation a lot. A lot of lenders, this is not just for mortgages. If you're in that situation, you're going to pay a higher rate typically. And we don't do that here at the credit union. As Alex said, as long as you have the legal documents, we do treat you just as if you're not on visa status, etc. So very good advantage for us. Okay. This is a strategic question, but a good one. And then we'll get on to the next slides and maybe come back to some. But, I know people think about this a lot. So if you're trying to buy another home, what's the best way to go? Use the equity in your current home when you're still shopping for the additional home, or trying to get another mortgage to use your equity, or do you look to get another mortgage? And that's really an individual question in a lot of ways, but any thoughts on that, Alex?
Good question. And the answer is it depends.
Yeah.
It depends on a lot of different factors. In some cases, depending on how much equity you have in your current home, it may be more advantageous to, say, take a mortgage against your primary home and then buy the other home cash. And then once the home sells from your primary home, then you would just pay off the loan. That's only good if the goal is to not have a mortgage on either property. In a case like if you wanted to have a mortgage, then it would be more advantageous to get a mortgage against the new home, putting 20%, 30%, whatever you're looking to put down, and obtaining the loan on that property. And then once the dust settles, you kind of figure out where you want to be.
And I think something we could work with you on that. If you wanted to run some scenarios with us, we would talk through that with you individually. I want to move on, but some of these questions are so good. We have to take a couple more.
Sure.
This is a great one, and we get this a lot for all our loan products. So this person is asking if they were shopping somewhere else externally and they found a rate better than the Merck Employees Federal Credit Union rate. That doesn't happen often, but if they did, would we match that rate? And I would tell you, if all the underwriting played out correctly and it was a bona fide offer, we would. But Alex, what do you see on that? Do you see that often, and what are your thoughts?
I don't see it as often, but I always mention to everybody, if you do happen to, I'm always willing to kick the tires and speak to Paul and say, hey, Paul, this is who the member is. This is what their profile looks like. This is the offer that they received. Are you able to match? or in some cases, you never know, might be able to do better. You just don't know.
We'll always look at that. We're always looking to help our members. So sure, if you have a bona fide offer from another lender, absolutely bring it forward. All right, so we have a few more questions, but you know what? Let's move on to the next slide so we keep the content going here. Here's our alphabet soup of acronyms. You're going to run into a lot of these during the mortgage process, so we thought it'd be helpful to talk through some of these.
Yeah, so there's some of the acronyms, not all of them, but a lot of them, the most prevalent ones that you'll hear. So the first one is the HELOC, which not really during the home buying process unless you're using the equity in your home to buy another home. HELOC stands for Home Equity Line of Credit. And what that is just a type of mortgage product. It's typically a second mortgage on your home if you already own one, that you could utilize in order to tap into the equity of your home. The next one we have is something called DTI. That one you'll hear all the time. That is basically your ability to repay, what they call your debt to income ratio. And how that is calculated, they take your monthly obligations and divide it by your monthly income. And that's how they come up with your debt to income ratio. And that is that magic number I was mentioning earlier. On the conservative side, as long as it's 40% or less, you're in good shape. LTV, which stands for loan to value, that is the amount that you are borrowing divided by the purchase price or the appraised value of the home. And what you'll typically hear is 80% loan to value means you're putting 20% down. PMI, private mortgage insurance, that is if you're not putting 20% down, the bank or the lender typically requires you to pay this. And what that PMI does, it protects the lender in the event of default. So if you happen to default on your loan, which we hope will never happen, the property would then go into foreclosure and the lender would have to sell. If the lender has to sell at less than what is owed on the property, then the private mortgage insurance company kicks in the difference to make everybody whole. APR, that is a big one. That is the annual percentage rate. So there's two rates that you'll see whenever a lender is advertising or offering you terms. You'll see the rate, which is the rate that you'll actually pay for the life of the loan. Then there's also something called the APR, which is the annual percentage rate. The annual percentage rate is calculated based upon the lender fees. So if you see a low rate with a high APR, that would indicate that the lender is charging you a lot of fees, and those fees could be in the form of application fees or what something called discount points in order to bring the rate down. So the rate could sometimes be something along the lines of a smoke and mirrors. If you have a ridiculously low rate but a higher APR, that means that you are being charged somewhere. And a good way to kind of look at the rates across the board is by comparison of the APR. That's a quick and easy way for you as the consumer to be able to determine if a lender is charging a lot of fees in order to get that rate that's being offered to you. Next one is PITI, which stands for Principal, Interest, Taxes, Insurance. On the mortgage, there are two components of your payment. There's something called your principal and interest, so that pays the loan back. And then there's also something called an escrow. An escrow could include taxes, it could include insurance, it could include PMI, or it could include all three of those items all together. So that's where PITI comes from. And then lastly, we have ARM, which stands for Adjustable Rate Mortgage. So like I mentioned earlier, we offer 15, 20, 30-year fixed mortgages, but we also offer adjustable rate mortgages. In adjustable rate mortgages, we have 5-year, 7-year, and 10-year adjustables. And what that means is the loan is calculated on a 30-year payment. However, the amount of time that the rate is fixed for is limited to those numbers I had mentioned. So for example, if you took a 7-year ARM, the rate would be fixed for 7 years. You'd be on a 30-year payment schedule. However, the rate would be fixed for 7 years. After 7 years, the rate could adjust on you. Typically, those rates are lower than what a 30-year fixed rate would be. And in some cases, it might make sense for you financially, depending on where you are and what your ultimate plans are. Example I would like to use is if you feel that you're going to be selling the home in 5 years or refinancing for a certain reason within the first 5, 6, 7 years, an ARM might make sense just for the fact you take advantage of some interest savings in exchange to get a lower rate for a shorter period of time of having that rate fixed for. So in cases like that, ARMs would make sense.
Great. Let's pause again. We have tons of questions coming in. Here's a couple. Can you use the home equity line of credit as a down payment to purchase a second home?
Yes, you absolutely can. We don't discriminate between whether it's savings or in a home equity line of credit. The only difference is if you do happen to use your home equity line of credit or home equity loan, we would just need to factor in that monthly mortgage payment into your total obligations in order to have you qualify.
Somebody also asked about a security-based line of credit where you would borrow against your stock portfolio to put money down. I think that's really up to you to do that. We obviously don't hold anybody's stocks, so you would have to go to your broker and pledge your portfolio to get some cash out if you want to do that. Another question, do you do new construction loans?
We do new construction. So new construction, sometimes it takes a little bit of time, depending on where the builder is in the stage of the process. You might be purchasing the home before the home is being built. We do offer new construction loans in that regard. When it comes to an actual construction loan, meaning you own the land and you're looking to build the home from scratch, we currently do not have that offering at the moment.
Yep. Extra principal only payments, do we allow for that? Is there any penalties to closing your mortgage out sooner?
So the answer is yes. We do not have any prepayment penalties. You can actually pay as much as you want, whenever you want, whether it's on a monthly basis or biannually basis, annual basis. It's entirely up to you. You could have the mortgage for a year, or you could have it for 30 years. There's no restriction. Additionally, what I usually like to say is one extra mortgage payment typically equates to probably 5 or 6 years off the life of your loan if you were taking a 30-year fixed mortgage. Yeah. So we actually encourage you to pay extra if you're able to.
A lot of questions on the jumbo loans. Are rates different for jumbo versus non-jumbo loans?
For us, there really isn't much of a difference. Some lenders will differentiate between what they call conforming versus jumbo. For us, I hate to say it's a one size fits all, but we try to keep things very simple. Paul's very good about looking at the whole picture and being ultra competitive. So like I said, we try not to make it too complicated for you and for us. We just say, you know what, we like to put our best foot forward out, and hopefully the stars align where it's good for you and good for the credit union.
All right, let's go on to the next slide. Rates.
So what typically sets a mortgage rate? Many people feel or hear that they see the 30-year treasury note. Unfortunately, that does not correlate to mortgage rates. The best barometer to determine where rates are going is the 10-year treasury. A lot of times, most lenders look at the 10-year treasury because typically a loan pays off within a 7 to 10 year period. So when they're evaluating their investment strategy, they look at the 10-year treasury note and they look at their return on the treasury versus the return on the mortgage. And typically what lenders will do is they'll price their mortgage rate either 1.5% to 3% above whatever the 10-year treasury note is. And that typically is what the driver is for mortgage rates. If the bond market is the yields are going up, then the rates will obviously go up. If the yields are falling, then the rate will fall. And there's a lot of different things that could affect this. Most recently, you have economic news across the world, what's driving inflation. So it's an up and down scale, I guess.
Yeah, so there's a lot of confusion of this because people say they saw the Federal Reserve cut rates, right? When the Fed meets, it's a big deal, and the Fed cut their overnight rates, and people expect all of a sudden that mortgage rates will go down, and that's just not how it works. fact, the last couple of times the Fed cut rates, mortgage rates actually went up because the 10-year Treasury went up. So if you're interested in like following this, you go to the Wall Street Journal. You can pull up the 10-year note like we show here on the screen, and you'll see the correlation. When this is up, mortgage rates are up. But it changes quickly. So even with this, we have some flexibility, right? If we see rates changing a lot, it really does matter what day and what week you look. So 10-year Treasury is really, really what you're looking at.
And one thing I want to add, Paul, to that is one thing that we do, I think that's very, very good that you offer, is we allow you to get the lowest rate from the date of application up until 5 days prior to closing. So if the rates do happen to increase, you know exactly what you have. If they happen to decrease, whether it be once or multiple times, we will honor the lower rate during that time period. So at no additional fee. So you're not automatically locked into what you have. You always have the best case scenario as opposed to the worst case scenario. And that's
right.
one of the, I think, the big advantages that we have here at the credit union. We have the ability to set our rates internally since we hold on to them.
Someone asked you about first-time home buyer. First-time home buyer advantages with the credit union. We do have some first-time home buyer advantages.
Yes, so typically we have reduced fees for our first-time home buyers. And like I said, we do have lower down payment thresholds and also preferred, what they call preferred pricing for your PMI, your private mortgage insurance. So maybe cheaper than it would be for a returning home buyer. So what it allows you to do is maybe put 3% or 5% down and have a lower monthly PMI payment than somebody who had already owned a home.
That's right. Great. Okay. Let's go on to the next slide. Points or no points?
Yes. So this is what I was referring to when it comes to the APR. There's something called points, or otherwise known as discount points. And what points are is paying interest essentially upfront in exchange for a lower interest rate. So sometimes you might see an interest rate advertised of, say, 5.5%, but there's 1 point involved in that rate. And what point would basically think of it as is a percentage of your loan amount. If you hear 1 point, that's 1% of your loan amount. And what that is a one-time fee that's part of your closing costs in order to lower your interest rate. It depends on the circumstances and the pricing of what that particular lender is offering, because what you should really do is look at what is your break-even point. What I mean by that is how long will it take to recoup the money that you're paying up front for that lower rate before you start to realize the savings. In some cases, you might have lenders that charge 2 points, which is a high number, and it's a great rate, everything looks good. However, it may take you 10 years in order to recoup that investment. And where that becomes an issue is if you happen to sell the home in 10 years. If the rates happen to decrease and you decide to refinance, well, that premium that you paid for that lower interest rate basically gets washed away, and effectively you ended up paying a higher interest rate because you paid the interest upfront in exchange for that lower rate. So it really depends on the circumstances whether to pay points or not pay points. I'm more of a proponent of not paying points, and if you do, try to keep it at 1 or less, because that's a more financially savvy decision to make. Because anything above 1, it really will take you a substantial amount of time to recoup that upfront investment.
Yeah, the length of time in the house really matters there, right? So, okay, that's great. Another good question. Wait, where'd that one go? Oh, do we do refinancing? Of course we do refinancing. Sure. Alex, anything different with the refinance process?
It's a pretty similar process as far as the purchase. We still ask you for the same type of documentation. But we have the same rates as if it was a purchase. Some lenders charge a higher rate as a refinance. We don't. So it's basically the same process as if you were purchasing a home.
Terrific. Okay. All right. Here's another one. Let's get this one out of the way. Are your loans assumable?
No. Our loans are not assumable. It's very rare that the loans are assumable. And most lenders do not offer assumable loans. I think the only ones currently are through the VA, which is Veteran Affairs, which we do offer those loans. However, we have a third party that helps us originate those. Those are for our military veterans. And in some cases, FHA loans, which stand for Federal Housing Administration, those are government-backed loans that in some cases are assumable. But no, we at the credit union do not offer assumable loans.
We're going to go through this one because the question asker even admits this might be hard to understand. So let's see if we get through this one. Following up on loan to value, say a house is valued at $600,000, but the selling price is $450,000 because it's going to a family member, so it's a friendly sale. Are you likely to get a higher loan amount because the house is valued higher? As is in the bank, it's more should you default. Hopefully this makes sense. I don't think so because the price is the price.
So I guess if maybe looking from like a qualifying standpoint, would they get a higher loan amount? Not necessarily. We always still have to look at what the income is and make sure that there's enough income to support paying the loan back.
I think he's saying if you're getting a bargain, are you going to get a bigger mortgage? You're not going to get a bigger mortgage. You're going to get a mortgage for what the price of the home is.
Yeah. So typically, like what we always do is we always look at the worst when on purchase. We always take the values on a worst case basis. What that means is we either look at what the purchase price is, or we actually always look at what the purchase price is. So if the property happens to appraise for a higher number, we would base our loan to value off of the purchase price.
Correct.
So technically, you wouldn't have any type of built-in equity towards your down payment. The only time you are able to do that, and you referenced that it was a family member, is if your family member gives you something called a gift of equity. And what that is if the home is worth $500,000, but they're only looking for $400,000 from you, they can gift you $100,000 on paper in order to satisfy a 20% down payment requirement, and we would recognize that.
Right.
So it's all about how to structure the loan.
Sure. And obviously, if you did that, you'd have more equity going in if you wanted to tap it with a home equity or something, right?
Yep.
Okay. Let's take one more here. Do mortgage lenders impose any practical or policy-based age limits in underwriting?
No, not at all.
No.
And I always use it's one example. I had somebody who was 87 years old and was looking to downsize from her split level to a ranch. Had a lot of money in investments and didn't want to cash them in because that was her income stream and there's capital gains. We ended up doing a 30-year fixed mortgage for her. And conversely, she actually came in and paid off her mortgage before her first mortgage payment because she was able to sell her home before her first mortgage payment was due on the new home. So it's in tandem. We don't discriminate based upon what your age is. So you can get a 30-year fixed. And secondly, whether you had the mortgage for a day or 30 years, there's no penalty to pay off.
All right. And here's a good one. Is there a reason you do not offer first mortgages in certain states? Missouri, as an example.
Missouri, I'm not 100%. I think we do offer Missouri. There are certain states that we don't offer mortgage, and that has to do with licensing. So that would be the only reason why. It's not a logistics reason. It's more from a licensing standpoint. So the one state that I do know for sure that we do not offer loans in is New York State.
New York, yeah.
So whether that's New York City, the boroughs, or the actual state itself. Unfortunately, we do not offer mortgages in that state. But other than that, there's really no specific reason other than licensing.
Okay. All right. All right, let's go on to the next slide. Next steps. So if you're interested in learning more, getting a more personal session, you can schedule a virtual phone or in-person meeting. And here are the QR codes below. So these are easy. You can scan with your phone. If you're not able to do this, certainly you can email us, call us, whatever you would like. I think Alex is also set up, right? We can set up a meeting with you. How do you do that?
Like Paul had mentioned, you could scan the QR code. We could meet in person. I'm here Monday through Friday from 8 to 4 here at 397 Upton Place in Rawway. A lot of people like to do Teams calls where we could virtually meet, whether it's either over the phone or on camera, and just kind of go over what you're looking to do and what options you have available to you.
Let's take another question. We're trying to get them all done before we wrap up. Someone is saying they last bought a home before COVID and the recent changes in rates. Is there any changes in financing, underwriting, or buyer risk to understand today before re-entering the market? I'm not sure COVID is a trigger for that, but
no, nothing has really changed on that front. The only thing that may have changed is different pricing based upon different properties. So, for example, I know we touched on it where primary residence has a different rate than a secondary residence. Post-COVID, the rates were higher on secondary residences because some people were purchasing those homes as second homes when they really weren't truly second homes, and either Airbnb-ing them or renting them out. So that's the only thing I could really think of that has changed post-COVID.
Right. Okay. I think we got to them all. That is great. Certainly, if you have any other ones, you guys can absolutely email us, contact us in any way. But we did get to most of the questions. So I think it was great. Instead of waiting to the very end, right? We did them throughout and got everybody's questions answered. I hope everybody found a lot of value in this. This is just the beginning. You can always reach out and get more information from us. But I just want the overall thing for you to hear is that your credit union is very flexible. Your credit union is very focused on giving value back to you during the mortgage process with great service, great rates, etc. So certainly if you're looking for a mortgage, you should definitely check out the credit union. We're really, really here to help our members get into good financial situations. So that is that. And just one more last question came in. Oh, here it is. This is a good one, actually. I'm glad this came in last second. There are some changes to commission structures for realtors, right? That has changed. Remember the rule with the realtors?
Yes.
So is that going to affect somebody's home buying process?
It can, as far as the cash that you have to bring to closing. So in some cases, if you agree to pay compensation to your realtor, you would have to pay them out of pocket as part of your closing costs. Whereas previously, the onus would really strictly be on the seller to pay the full commission. And one other thing I want to touch too that I didn't mention is at the credit union, depending on if you're a Merck employee or not a Merck employee, a lot of people ask this question is, what if I happen to leave Merck for whatever reason? Once you're a member, you're always a member of the credit union. So the mortgage would stay here as if it was, it was any other institution.
Correct. And somebody asked for sharing of our emails. So we're going to do that here now in the link. However, you will get an email that will give you some more information. We'll include the emails in there. And also this will be archived on our website, and these slides will be on our website. So a lot of ways to get a hold of us, but there are the emails. And again, if you want to talk about the mortgage process, Alex is the person to reach out to. All right, I want to thank everybody for joining. Alex, thanks for your great insights. Thank you guys for all taking some time out of your day to learn a little bit about the mortgage process here at the credit union. And we hope to hear from you soon, and good luck. Thank you, guys.